Started?
Yeah, let's go for it.
All right. Well, again, my name is Chuck Evans with Windsor Advantage. We're a lender service provider headquartered in Chicago, Indianapolis, and Charleston, South Carolina, one of my favorite places. And we have this 30 at noon webinar on a monthly basis, usually the third Thursday of every month. And it's not to take the place of NAGL or NADCO or the good training programs that our friends at the SBA do, but to share best practices in SBA lending in different topics. And we've had the pleasure of having Paul Santomauro on last month and probably this month. So it's a series of webinars to try to introduce community lenders to franchise lending. We can be the best processor, closer, and servicer in the country, but if we can't help drive business to or identify business for our clients, it's kind of all for naught. So today, Paul, I'm going to turn it over to you. We usually take this about 30 to 45 minutes, but if honestly, it's a good topic. If you want to run through the hour, we can. We'll send the PowerPoint out to everyone and just keep it on your calendar, April 21st, Thursday for our next one. So Paul, welcome and good to see you.
Thank you. Good to see you, Chuck. Thanks for having me on again today.
Surely.
For a little bit of background about myself and FRANdata for those that are new to my presentations. FRANdata is the leading research and consulting company in the franchise space. Our main clients are lenders, so the group that are on the call today, as well as franchisors, so the brands themselves, and the third group that we call suppliers, so anyone that might be selling into the franchise brands or banks, and also the private equity groups that are doing kind of the larger transactions and engaging us for consulting and research in those transactions. Today, we're going to talk specifically about building relationships with franchise brands and what that business development process looks like. In our previous session, we talked about kind of the economic outlook and the underwriting side of things. But now that we've assessed that there's a tremendous amount of opportunity, kind of where do we go from here and how do we start to build those relationships with concepts and what does that process actually look like? So we'll take a couple slides to just kind of set the table, refresh a couple of things about why are we here? Why is there such a great opportunity? What were the factors that happened in 2022 and 2021 that created this opportunity? Then we're going to look at how to actually prepare your bank. And this is going to be about driving alignment internally and how to kind of drive alignment between the credit teams, BDOs, and leadership inside your organization. Then we're going to dive right into the development process, talk a little bit about some of the challenges and how to size the marketplace and things that you're going to face along the way. And then we're going to dive into the two approaches that we're going to talk about today. A top-down approach, which is building brand level relationships with the franchisor executive teams. And then the bottom-up approach, which talks about targeting existing franchisees and what are some of the challenges and the nuances and the unique ways that we need to approach that. I have some time built in for questions at the end, but if you guys have questions in the middle of any slides, just kind of interject. I think there's a chat box.
There's a chat box.
Seeing those questions, yeah, just jump in over me, and we can address any questions as they come in during the presentation too.
Perfect. Thank you.
Sure. So a little bit of a refresher, just to kind of, again, just understand where we are. What were the opportunities that were created in 2020, 2021? Why was this so unique? The pandemic and the changes that we saw are forcing a lot of adaptation in the franchise space. Brands are favoring smaller footprints. They're trying to favor more efficient build outs. So we're seeing a lot of changes to the models that are being presented to your franchisee borrowers. A lot of the opportunity we're seeing, apart from new units construction, which we always see in franchising, is a lot of remodel and refresh initiatives. So things like adding drive-through and pickup windows, different adaptations that brands are doing as a reaction to the pandemic and the different changes that we've seen in the marketplace and the different consumer demands that we're seeing changing in the economy. We're seeing a lot of M&A activity, right? So transfers and acquisitions, both in among franchise brands. So we talked about kind of private equity firms that are gobbling up franchises, but also within franchise systems with stronger operators buying out a lot of the smaller underperforming units within franchise systems. So what this has created is pockets of underserved needs in this space, especially in the 350K and under, and even at times the 500K and under investment size is a really big need right now in franchising, which is something that we talked about, ongoing on these sessions over the last couple of months. and really want to hammer home again this point that we'll see throughout the session, that small banks really can make an impact. This is not about large institutions that have national coverage, and we'll see that in some of these slides. Small banks really can have an impact for these franchise brands and in the franchise space right now. Also, again, wanted to refresh some of the brands and industries that we're talking about here, and kind of what's topical, what are we seeing in requests from both the franchisor and the lender side. The food space has always been big in franchising, and we're seeing a lot of that coming back, especially in the kind of to-go brands like Scooter's Coffee. Tropical Smoothie is a brand that has a fantastic fund score and bank credit report, is doing extremely well. A&W Stores is one that we're having a call with next Monday. They're looking to do some refreshes and remodels in their system. So you're seeing some of these industries that kind of go with the pandemic and are aligned with some of those that we've talked about, in the past and on some of these previous sessions. The key takeaway from this is that the credit landscape in franchising has shifted both for lenders and franchisors, and that's what's creating these opportunities for smaller lenders and newer actors into the space. Some of the lenders that were already in the franchise space found themselves with concentrations in certain industries that were disproportionately affected, right? So, we think about what this has created in terms of pullback. Lodging and sit-down restaurants were the obvious examples. But overall, there's been a much sharper focus on the franchise business model and how it was specifically affected by COVID. And this has tightened the credit quality requirements across the board in a lot of institutions on both a borrower and a deal perspective. So banks have kind of pulled back from some of the deals that they've done before and not done as much volume in certain areas, certain spaces, certain brands that they maybe have done in the past. Overall, they've been less likely to take on deals in emerging brands. And for those that haven't been on sessions before, for FRANdata, an emerging brand is any concept that has less than 5 years of franchise disclosure documents and less than 50 franchise units in the United States. Anything more than that 5 years of FTDs and 50 franchise units we'll refer to as a mature brand. And generally speaking, also much more cautious on taking deals for startups and single unit owners, often looking for higher cash injection levels and other different mitigants to be able to get comfortable with those types of deals. So we're seeing a shifting landscape in the types of opportunities that the traditional franchise lenders are actually looking at.
Hey, Santo, and correct me if I'm wrong, FRANdata can also do an evaluation of the emerging brands to a certain extent.
Exactly right. Yeah, that's a good point on the availability of information. We've talked about in previous sessions our fund report and our score, which can be thought about like a FICO score for a franchise brand. We do that scored methodology on all the mature concepts, right? We don't do a fund report on an emerging brand, but we do have a report called a pre-fund report, which looks at some of the same metrics that we look at in a fund report. But the key difference there is that we need to see a certain level of seasoning in a franchise brand before we actually put a scored metric to that concept. And that's the very, very boiled down explanation of why we'll do a fund report for a mature brand and not for an emerging. But we do have a ton of information. And really when it comes to an emerging brand, and we're not talking about underwriting on this call, but transparency really is the biggest issue there. Are they disclosing information in item 19, the unit economic information, in item 21, the franchisor level financials? So what's the level of transparency and disclosure for an emerging brand? And then we start to look at kind of the quality of the numbers and how it benchmarks against their peers. So that's what's important to us with the emerging brands. So like we were saying before, it's opened up pockets of need in these franchise brands with initial investment sizes of 350K and under. But also, other projects that may not be an initial investment of opening a new unit, but might be a refresh or a remodel, or as we talked about, an acquisition or something like that. And banks are just kind of saying, look, why should I underwrite for 350K or 250K when I can underwrite for $1 million or more, and get a little bit more comfort level with a larger deal and maybe a better operator. I talked about before, banks are asking for larger injection amounts on smaller deals, so asking for a little bit more skin in the game. But there's a real opportunity for banks out there that can get comfortable with specific brands in investment sizes. And that's part of what we're talking about today, is how to build direct relationships with individual concepts, not saying that we're going to be lending to everybody in the QSR space, but a couple of brands that we can get comfortable with that are in our region, in our territory, typically are able to drive alignment much more fully within your organization.
And I like this, Santo. I like the fact that, if I'm a community lender and I'm not familiar with franchise lending and I want to dip my foot into this, I like the idea of some of the smaller transactions. And we at Windsor are trying to help our clients kind of get their feet wet in
Absolutely.
this. It's a great opportunity.
Yeah, and we'll see in some of these slides too, is that it's not just about startups with some of these opportunities. There are refreshes, there's remodels, there are things that are kind of part and parcel of businesses that are already running and operating. So that's really fantastic. And the mature brands as well are also looking for partners. And that's something that's really unique, again, about the last 2 years, which we haven't seen traditionally in the past. You have these larger franchise brands that have really established relationships with banks. Some of these franchisors saw their lending partners not handle the PPP program that well. So there's some friction there. And others, as we said before, had their partners just pull back due to concentration issues in their portfolio. And thus we see really, really strong brands as well as the emerging brands looking for a new partner. So that's where some of this opportunity comes from that we're seeing in the space now.
I think that, and correct me if I'm wrong, a lot of the franchisors want to come to a community lender that can get it done. And if you think about it, 75% of the lenders in our space do less than 6 loans a year. And it sometimes can be a frustrating process. So franchisors are looking for lenders that are going to be efficient, process efficiency, quick no's or conditional yeses. So
yep, and that's a wonderful transition actually to this slide. When we talk about preparation and being aligned internally. And then the point you just made is the last bullet point here, which is how these points make you a more reliable partner and help you build those deeper relationships. It's one thing to engage with these brands, but if you're not able to efficiently process the deal, and like you said, that doesn't mean saying yes to every deal, but being able to give them clearly defined no's and yeses will make them a more reliable partner. But how do we do that? How do we prepare for this process is to be aligned internally. So the first thing is on the credit side, having banks that are having clearly defined credit boxes, that's going to make this process a lot less friction in this with your internal teams. That's also going to allow you to enable your BDOs with a clear direction for what you guys think are bankable internally. So those can be sectors and industries, they can be specific brands, but enabling your biz dev team with a clear direction of what the deals you can do is really important. And those two together are going to drive the confidence and the alignment internally with your leadership teams, with your board of directors and those types of groups. And all that together is what makes you a reliable partner to these franchisors. And all that has nothing to do with the size of your bank or your footprint or your total assets under management or anything like that. It's just about your process and the way that you engage with the franchise space and the information that's available.
And you can probably evaluate these franchisors before they even come to the door with the information that you and we have. And so you can say, okay, we're in the state of Washington and we want to play within, say, $500,000 to $1 million. What kind of risk profile do we think about that first before one comes to the door?
Yeah, absolutely. And that's some of the work that we do on the biz dev side. And we're going to actually talk about that in some of the slides here, where you can hone in on those parameters, on those initial investment sizes, looking at the footprint of the brand, right? So where they have current units and where they're projecting new units. And insofar as that overlays with your footprint as an institution, then it's almost always going to be worth it for you to at least have a conversation with the brand. You may well build in the funds score and report to that as well, right? So then that brings in the franchise credit performance of the brand and other parameters like minimum net worth and liquidity, say, of the franchisee. And all that stuff goes into kind of how the brand operates and what might be a good target for you. So those are actually really, really good points. Where is this activity actually happening? Right. And this is just developing a little bit more about what we talked about before. The opportunities that we're seeing within these existing brands are not just about new unit growth, right? So the transfer activities, which we talked about, new units are being sold from one franchisee to another. Typically, these are multi-unit owners and the loans are larger multiples of earnings. So the investment sizes are larger on these deals. So you may have a brand that has, $100,000 initial investment size, but in a resale transaction with maybe some multiple units, that's a deal that can approach several $1 million. So it's looked at a little bit differently. Big message here, just take the first steps, right? Lenders don't need to have a comprehensive national lending solution to build a program relationship with a franchise brand. Like we just said before, look at the footprint of the brand. Where do they have units? Where are they projecting new growth? If there's growth in your footprint, having that conversation is going to be worth your time. Franchisors would obviously love to have a one-size-fits-all national lender, but that is not the reality of the current economic condition that we're seeing in the marketplace. The executives at these brands are actually there to cultivate these relationships with multiple lenders because they have different needs within the system and throughout the country. So just as we've talked about, new unit growth, transfers, remodels, something that we haven't talked about before for any of the conventional folks that might be on the call, franchisors have a need to take their SBA franchisees out from SBA loans and kind of graduate to a conventional product and all the support that's needed with that. As well as folks that might be on the call thinking about, what are the other types of banking products that I might be able to sell into the franchise space, like, deposits and cash management, estate planning and things like that. This space is also a great area to prospect for those types of business objectives as well. So really a lot going on in the franchise space. Just jump in there and take the first steps and use some of the data that Chuck and I have available through our organizations to help you with that. So we set the table, we prepare ourselves. And now we're going to dive in specifically into the development process itself, look at some of the challenges, and then kind of tease out the two different approaches, right? So we talked about the top-down versus the bottom-up approach. We're going to look at how to reach decision makers at the franchisor, right? So these are brand level folks, VP franchise development, CEO, and that type of thing. We'll look at some key discussion points with brand leadership. Now, those slides are kind of very top level discussion points, and we can certainly help you develop some conversation points with these brands. But what are important things to talk about and discuss with brand leadership? And then we'll shift gears and look at the bottom-up approach, which is targeting franchisees. We're going to look at some different types of franchisees, area developers, area representatives, and multi-unit owners, and what are the differences there, and then talk about how to reach the high-value multi-unit owners, the folks that own multiple units, the 5, the 10, the 20 unit owners, and what are some of the challenges that come with targeting those folks. So like we've teased already, a top-down approach means we're building direct relationships with the franchisors and the executives at these organizations. Now, a lot of these brands actually have strong actors that are in these key roles, these key positions at the brand, right? So Chief Development Officer, VP Franchise Development, and these concepts are actively driving franchise finance and recruiting together in this role, right? And that's typically on the management level. So one of the great examples is a gentleman named Ty Massey, who's the Primrose School's VP of Franchise Finance. He's actually has a long experience in the lending world as well. Now, with this type of a relationship, you're getting deals to flow directly from the franchisor and franchisees and other intermediaries within the brand. So, having gotten comfortable with a franchise brand, having gotten comfortable with the types of deals they're trying to do, the footprint in which they're growing, and all of these parameters that you've set up being equal, you may be willing to finance 5, 10 million, however many, dollars worth of deals to a specific brand. And that's a fantastic way to get another avenue of deal flow, other than deals that are coming off the street, regular recruitment, and of course the brokers and the other referral channels. You get that direct deal flow directly from the brand. It's a fantastic way to start to build a book of business in franchising. And for many of the brands, as we're going to see, FRANdata can advise on the best point of contact. So we in part of our relationship with franchisors is running the franchise registry website, and in part of that relationship is the ability for franchise brands to provide their contact information and their franchise disclosure document for lenders. We also create their fund report and score and share it with them during that process, right? So they kind of know where they're strong and where they're weak. But through that, we get a tremendous information flow from the franchisors through lenders. And in fact, if you're logging on to the franchise registry, one of the best ways to find the contact information for these folks and reach out to them is to actually log on to the franchise registry website. Now, everyone on the call has access to a free tier login for franchise registry, which is going to have a good percentage of the franchise brands in the universe on there and available for you. It's not a comprehensive access, so our subscriber lenders that are on here and the folks that are working with Chuck are going to have a more comprehensive ability to look at this contact information, download fund reports and the like. But I do encourage everyone on here to at least get that free tier access, because with a brand like Primrose Schools, which is paying for their access on franchise registry, has a bank credit report and other items, you're going to be able to come in here and get this contact information that I've highlighted right on the homepage for the brand. And this is information that we're getting directly from the franchise that's being made available just to lenders. So it's a much higher value information than you're going to find in, say, a franchise disclosure document or something like that, when we're trying to reach the executives. Now, you'll see here that there's kind of 3 different categories of contacts, and they correspond to the responsibility of that individual and the types of questions that you can expect to have answered by that representative, right? So the franchise financing contact is a contact that can answer any underwriting questions that you might have with a deal. So how my borrower's projection is X, is it in benchmark with what we should expect from the brand? I have a question about the ramp up period of the royalties, or actually a really interesting question I got from a lender the other day was she had looked at a deal and saw that the brand had given royalty relief in 2020 and 2021. And that was affecting the P&Ls that the borrower was presenting for this particular deal. And she wanted to know, well, when are they going to turn those royalties back on, and at what rate, and what's the step-in period for those royalties that are eventually going to be turned back on and are going to be falling down to the bottom line. And that would be something that you'd reach out to there. Now, Ty obviously is a former lender, so he's got a fantastic experience in what you guys need to process these deals. And he's the franchise financing contact for Primrose. Franchise sales, though, is the one that you want to key in on for the business development folks that are on the call. Franchise sales is the person that's responsible for having these meetings and sussing out the direct lending relationships with specific institutions. So that's the contact there for that. And the SBA contact is the contact for all of our processors and closers that might be on the call. If we need to get a signed document prior to closing, typically it's Form 2462 or the SBA addendum. Of course, we know we need signed franchise agreements prior to closing and first disbursement of funds, all that kind of technical stuff that comes with the closing and documentation. You'd reach out to the SBA contact at the brand. But this is really the easiest, lowest hanging fruit for everyone on the call. Get that login on franchise registry, get on here and grab the contact information for the brand, and you can very easily reach out and engage the concept with a conversation.
Awesome.
So let's take a look at some of the discussion points. So what's topical? What should we be thinking about when we're going into these conversations? What do we want to draw out from franchise brands that is going to ultimately drive comfort level internally? That is the point of all of this, is to ultimately drive buy-in among your institution to be able to enable you to go out and effectively get these loans done. The first thing is to really dig in and understand the support and the guidance that's given to borrowers, right? Question the training program, question the grand opening support. Is there ongoing support? Is there support for distressed units, right? Some franchise brands have kind of specialized rescue teams that can, jump into a unit and support it for a certain number of months if there's issues. So, really understanding the support and training pipelines for the brand is important. Looking deeply at the franchisee selection practices. So this has to do with the minimum net worth and liquidity requirements as well, but really understanding what the development people are looking for in a borrower is going to help you as a lender better assess the viability of a potential loan and really what that borrower is going to need throughout its life cycle, right? So we're going to close this loan. Is this borrower going to need any kind of post-closing liquidity? Do they need, a 7-8 working line or something like that after closing? Really having a deep relationship with the brand, understanding this is the type of borrower we're looking for. This is the type of business acumen that they need. What's their past life and work experience? Do they have an energy level and a commitment to the brand and the mission? Or is it somebody who's just looking for some kind of financial diversification in their portfolio? All this stuff is really important. And insofar as you can get more aligned with what the franchisor is looking for, you can become an even more effective partner for them. Our clients have found a correlation between the brands who really deeply and fully understand their franchisees and the success rates of the loans and the follow-on success of the borrowers, especially in these young concepts. So when we talk about these emerging brands, these brands that have less than 50 units, franchisee selection is so important. And we really don't want to see, we talked about transparency before when we talked about emerging brands. We don't want to see units closing in the first year, 2-3 years of an emerging brand operation, what we sometimes call digestion issues, right? Where we didn't pick the right borrower, or they didn't have the right location and have the right business acumen, and we're kind of struggling to find our stride and get the right fit within the franchise system. That's one of the red flags that we look for in emerging brands. Every franchisee is going to face issues that they don't know how to solve. Some of these brands are better at supporting them than others, and that's why it's really important to kind of question some of these aspects when you're having the direct calls with franchise brands. A word about multi-franchise organizations, right? So there's sometimes organizations that own multiple brands, and you sometimes think, well, wait a minute, am I going focus brands? Am I going at, a specific brand within that? Think about those concepts: focus brands, exponential brands, Yum brands as an example. There's a lot of opportunity in these concepts, both for cross-pollination of brand relationships within the franchisor level and the franchisee level. Typically, the franchisees will own multiple units across these brands, so it's the ability to kind of be cross-pollinated to other concepts. And also on the franchisor level, right, if we're assisting one franchise brand within a system, we're more likely to be able to have exposure to some of the other concepts and executives in the system. Also an opportunity for an increased comfort level internally with a new emerging brand if it's owned by an experienced franchisor, right? So in one of these examples, and there's a ton of those, are a brand called Yoga 6, which is owned by Exponential Fitness. And that's a group that runs Pure Bar and Cycle Bar and AKT Fitness, and actually has a wonderful track record and experience of building value in these emerging brands. So that's another thing to look for, again, with an emerging brand that's owned by an experienced franchisor to again drive comfort level for these types of deals internally. So we've talked about top down, where we're targeting franchisor executives and the key conversations that we want to have at that level. But we also want to talk about this idea of bottom-up targeting and targeting franchisees within a system. Some franchisors just don't take as active as a role in financing on the management level. And the best way to target these folks is to target direct to the franchisees and kind of be recommended up through the system as a great partner, and then be invited to a discovery day or something like that. But when we want to target franchisees, we have to ask a couple questions. And we really need to understand the marketplace, because there's some unique challenges with each group. So who are we targeting here, right? Are we targeting single unit owners who just own one unit or maybe two? Or are we targeting the multi-unit franchisees, which could be anything from a 3 to 4 store owner all the way up to a 50-unit behemoth, owner of Firehouse Subs or something like that? And really important to understand, what are the different types of franchisee owners and how do we target them, and who should we be targeting in this group? The first one I want to look at just briefly for you guys is area developer. So like I said, we're going to look at area developer, we're going to look at area representative, and then we're just going to look at a multi-unit operator. Now, all the slides, all the research that you're seeing here is primary research that comes out of our franchisee playbooks product line, which is specifically designed to help you target and get to the decision makers at these high value targets. The best way to think about this is that the more and more units a franchisee owns, the more detached they become from the day-to-day operation of any single unit, right? They tend to have layers of organization that are building up between them. They have managers, they have directors, they have financial people, and it becomes more and more difficult to reach the decision makers at these franchise brands and the more and more stores that they own. So that's why we do some of the primary research and some of the things that you're going to see when we look at area developers and area representatives. But think about an area developer as a franchisee that's paid for the right to open multiple stores over a specific time period, right? Now, the number of stores that they can open can vary by system. Sometimes franchise system, you might hear a terminology, oh, I offer a 3-pack or a 5-pack or something like that. It can be as low as 2 to 3 businesses. It can be as many as 100 locations, depending upon the agreement of the brand. Now, these are very highly desirable franchisees because they're going to be opening more businesses. They're typically of a stronger credit position. They've been vetted by the brand. They may have ownership in other franchise concepts as well, and they're getting into a new brand. And so important to understand what an area developer is and the schedule that they're going to be on and the number of units that they're going to be required to open in terms of how you approach the borrower and the types of financing options that you're going to present to them. Now, this varies from an area representative, which is responsible for opening units in most cases. But an area representative responsibilities also include identifying, recruiting, and qualifying franchisees for the franchisor, who's then going to go on and sign agreements with other borrowers, right? So when we're looking at an ownership group here, this M&M Development Group under Marco's Pizza, well, we can see that they have 4 locations that are owned and operated. But are they as good of a target as an area developer? Well, they have at least a portion of their responsibilities are dedicated to the training services and support and opening, continuing operation of other franchisee businesses. So they're not necessarily going to be opening up more businesses of their own. They're more likely to be supporting the development of other businesses and may not be as good of a target for new store growth or other types of financing as an area developer. Now, many of the franchisors still require that these area reps open units of their own. So there is still opportunity there, but it's important to, again, understand the distinction between these 2 types of what otherwise would be called multi-unit owners when we're looking at franchisees. And the final slide I have here is kind of an example of one of these franchisee playbooks that we would do on a multi-unit owner, just to kind of give you a sense of the complexity that goes into targeting a larger multi-unit franchisee and the type of contacts that you need to kind of link together to really affect getting to a decision maker. This is a company called Lenfan Management Inc. They own a bunch of Wendy's and a couple other concepts. And what we've done in this research is really sketch out the organization. And you can see the founder is a gentleman named Spyro Lennis Sr. But the organization has now been taken on and run by his family. He has 2 sons and a daughter. They're in other organizations as well. They have commercial real estate. They have car washes. And we're able to link together this group back to Lenfan Management and then develop some of these operators. So this gentleman here, Anthony Cristiano, is the CFO of this Lenfan Management and has linkages in this organization, as well as Sam Nasser, Director of Operations. So these are things that you can't just get from looking at LLC information, addresses, unit locations, and that type of thing that you might traditionally think of in the contact list space. A real solution for targeting multi-unit owners has to take into account the complexity of these organizations. So that's something to think about when you're thinking about targeting the larger operators. When we get above that 5-unit, that 10-unit number, it's going to take a little bit more than just kind of pulling the store locations and kind of doing some of the traditional outbound outreach that we think about when we talk about marketing.
Hey, Santo, how do you see community lenders getting into this, looking at the smaller transactions, the one owner franchises, or are they biting the bullet and going for the larger transactions?
No, I think single unit operators are a fantastic way, and that's the next slide we're going to take a look at. Multi-unit owners are great as well. And you're going to find that, let's just say you're taking let's just say Tennessee, for example, we're going to take a state and maybe there are a couple brands that we've identified that had high fund scores. And now we're looking at the franchisees within that organization. You're going to have a pocket of them that are single unit owners, maybe 40% of the universe. Then you're going to have, 10% of the universe that's 2 to 3 unit owners. Then you're going to have your big ones. I would take a run at the single unit owners and as well some of those smaller operators as well. And that also has to do with the types of loans that you can do, your lending caps, are you SBA versus conventional? All that's going to determine what your target set is. But if we're talking about the SBA program and a $5 million cap, I think the 2 to 3 to 4 unit owners is probably the max in terms of where you want to play.
That makes sense to me as well. Yep.
Yeah. What's really cool though with the single unit folks is that they can also be targeted with some of the traditional ways that we know about. So like outbound calling, outbound mailing, actually visiting locations. You'd be surprised is actually a really good thing to do. What's interesting about the single unit folks is that you can imagine they're more likely to be kind of involved in the operation, right? They're in the unit, they're answering the telephone, they're opening the mail, they're kind of going through it. So from our perspective, targeting single unit operators and accessing our traditional contact list database for that group is much more effective because in that way, we're able to, pull quotes and get information that have the business addresses, sometimes telephone numbers, sometimes email addresses, but not always, but information that allows you to target those single unit locations. Some of the challenges that we see with that, though, is that we'll typically have some information, but not all the information, right? So we may have an LLC name or a contact name, right? So you might have Chuck Evans, or you're going to have Primrose Schools of Port Deposit LLC, let's just say, for example, but we won't have both of those. So you'll have some information to go on, maybe a store number to call, an address to send a mailer to, or maybe even visit in person. But those are some of the limitations of this contact and product line. So you can see that building a profile of a multi-unit owner can be challenging, but it does give you some really good information to target the single unit owner. So I would recommend that part of it as well, for the folks that are listening and thinking about, hey, where to start with this. Looking at
I think as a risk officer, a small community bank, that makes sense. Take the single unit. Let's get our feet wet. Let's get comfortable with this, and then kind of expand and expand the risk.
Yep.
Hey, we have some questions. Do you have a few minutes? Okay. John Fogelman started out. You mentioned larger injection requirements. He was asking how much more are they requiring?
I've heard 30%. 30, 35.
Okay.
Yep.
What about, and what percentage of these transactions are SBA, would you estimate?
From our clients, a large percentage of them are SBA transactions. And when you're dealing with, like we're talking about, first unit, second unit, third unit with a 400K, 500K initial investment size, even up to 800,000, you're still well within the SBA parameters.
That makes sense. Okay.
Where we look at conventional, I was just going to finish the thought with conventional deals you'd see with larger investment sizes. So think like Urban Air Trampoline Park, those types of things where it's a $3 million build. So you're one and you're out of SBA. And then the kind of takeout piece, right? We've done SBA, but we need to graduate to conventional. We're seeing some of that activity as well.
You have a history, you have a comfort, the risk is less in some cases.
Yeah.
John also said, when you were talking about probing the franchisor or the franchisee with questions and what questions to ask, is the support systems of these factored into the fund score?
Yes. Yeah. I didn't mention that. I was going to mention that before. That category is the system support and expense commitment in the fund report. So what we look at is, what are the services that they're providing? How do they benchmark against the peers and what we would traditionally expect in franchising? And then what's the percentage of the revenue of their top line expenditure, that they're putting towards those services? And we give a percentage, right? So are they putting 30%, 40% of their expenses back into system support and expense commitment? And those factors are what dictates the score in that category.
Okay. Another question came up. Most of the national franchises have their own approved lenders list. How do we get around that?
Yeah.
I think the space is so big. The space is so big. There's opportunities outside of that area. Am I right?
Yes. What I would say, I wouldn't even say outside of it. I would say pick up the phone and take the first step, because I've had so many calls with franchisors that have said, here's our preferred lender list. This one doesn't work anymore. I need new. So yes, there are brands that have had the traditional preferred lending lists in the past, but this is the opportunity to challenge some of that, because there are openings and availabilities to build relationships where there haven't been in the past. So don't be discouraged by
that. And I would guess that the pandemic has created a stir of change, and so there may be some franchisors that had good relationships that maybe are looking. So.
Precisely. Yeah. And that's what we were kind of hinting at before with all the upheaval in the pandemic, and lots of different reasons, right? Yeah. Portfolio concentration, sector and industry issues, specific brands that maybe they don't like anymore. And even maybe bankers that have changed banks, right? If you had a group person that was really
that doesn't happen, does it?
Restaurant space and either left or retired or something, that could be a reason as well. So lots of causes for that.
Hey, tell us about some of the mistakes you've seen lenders make getting into this space.
Big one is to not size the opportunity. So to not take the biz dev and the credit question together, right? Where I've seen lenders stub their toe is they build out a credit box and then they turn to get deals and realize there's no deal flow, right? They identify, well, here's the 15 brands we really love. And then they try to go after them and they find there's not a lot of opportunity. It has to go at the same time. right?
Yeah.
You have to start to say, okay, we want to be in franchising. Here's some sectors and industries we think we like. At the same time, we want to look at the credit and we want to see, is there opportunity, which means, are there transfers? Are there new units expansion happening? Maybe we talk to some franchisors, that kind of thing, and do it in parallel so that you don't expend a lot of energy putting a credit policy in place where there isn't any opportunity for you.
And I think that's the point of getting with you and getting with us and identifying the ones that fit that risk profile first.
Yeah.
Any other questions while I have Santos still on the line? I think we've hit them all. We're at our time, I think, Santos.
Awesome.
So,
Awesome.
when are we going to see FRANdata again at the Nagel spring conference, I think?
Yeah, we'll have some folks, I think, at Malk in April.
Yep.
I won't be attending that, but I will be at the Nagel Atlanta.
Okay.
And then I think we have America East. There's a lot of events that are going to be in the last half of the year. And we also attend franchisor conferences as well. If you folks are, and that's something that we actually didn't talk about on this, but there's great franchisor events out there, multi-unit franchise conference, Springboard, restaurant finance and development, all that kind of stuff. So yes, you'll be seeing us.
I think we'll probably put some of those together to send to our listeners next time. That's a great idea.
Yeah, that would be wonderful. We'll do that.
The other thing I wanted to plug, we for Lenders Connect was formed by a lot of us to create a community for education, for communication. And if you haven't signed up for it, look at this and you'll get the smallbusinesslendersconnect.com. It's just a group of lenders talking to lenders and helping grow this industry. So Thank you so much, Mr. Santomauro.
You're welcome. I put my contact information up there if anyone wants to email me with questions or anything offline. And Chuck, thanks again for having me. We'll see you guys soon.
Sure. And we will see everyone again next Thursday, April 21st. And I believe you're going to join me again, are you not?
Yes. We're going to put together, I think we were talking about before, a panel of franchisors and
Yep.
get a little bit more interaction with the executives that we talked about here, and maybe even open up some avenues for you guys to reach out to them directly after the call.
Awesome. Everyone will get a copy of this. I believe we've recorded it. So if you want that, let me know and let's go. Thanks.
Awesome.
Thanks, everyone.
Thank you, Chuck.
Take care.